I'm Ron Port from SayAnythingBlog.com. The fiscal cliff is looming in Washington, D.C. We're all following the news of the negotiations, or I guess at this point, the lack of news about negotiations. But I think maybe we need to quantify what perhaps the impact of some of the things being discussed as a part of this debate could have on North Dakotans. The Tax Foundation recently put out a report talking about the impact that the fiscal cliff negotiations, or at least the tax side of that, could have for citizens of the various states. And North Dakota was listed as one of the top 10 states that could see the most dramatic impact from some of these potential tax changes. Per household, the possible tax increase from 2011 to 2013, according to this report, was $4,825. Here to talk with me about that is Nick Kasprak. He's an analyst for the Tax Foundation. Nick, thanks for your time. Can you give us some details? How was that figure, $4,825 per household? How was that reached?
Sure. Well, so what we wanted to do in this report is we wanted to get a sense of what does the fiscal cliff mean for actual real people? You see all these huge numbers bandied about, and it's hard to kind of understand them on a personal level. So we looked at the median family in each state, so kind of the person in the middle. So North Dakota, the median family with 2 kids, according to the latest data, makes about $84,896 in household income. And that data is from the 2011 American Community Survey. So that's actually relatively high. North Dakota is kind of on the upper end of states in terms of median household income. North Dakota is doing pretty well. A lot of natural resources and economy is doing pretty well and so forth. So that's pretty high median household income. And what we tend to find is that states on the basically on the low end and on the high end do pretty well, and states in the low end and on the high end are very affected by the fiscal cliff, whereas states in the middle not so much. There's a bunch of different components of the fiscal cliff that are causing this. So there's 3 basic things here. The first one is the Bush tax cuts. Obviously, that's sort of the big one that everybody's worried about. The second thing is the expiration of the temporary payroll tax holiday, which, as you remember, it was started in 2011, was extended through 2012, and it's set to expire at the end of the year. And that will most likely expire. I don't think anybody is really talking about extending that for another year. It doesn't seem to be a popular item. So there's the Bush tax cuts, there's the payroll tax cut, and there's also the alternative minimum tax. And this is a little bit more confusing because the AMT, as you may know, is sort of this alternative income tax system that was originally designed to target upper class families. It sort of originally, the purpose of it was kind of like what the Buffett rule is supposed to be. It's supposed to sort of set this minimum tax level that everybody should pay, for upper income people, and it's supposed to limit deductions and so forth. The problem is that the AMT was never indexed for inflation. So over time, it sort of grabbed more and more people and is starting to affect, upper middle class and middle class families. The latest sort of permanent change to sort of the AMT parameters happened all the way back in 2000, 12 years ago. And every year since then, Congress has passed a temporary AMT patch, if you will, which kind of tweaks it a little bit so that it affects roughly the same number of people. But the problem is that all of those patches are temporary, and they all expire after a couple of years. So the most recent AMT patch was enacted for 2010 and 2011, and there is no patch in place for 2012, let alone 2013. So often Congress will pass kind of a retroactive patch, which then they do as part of the fiscal cliff negotiations that would apply to 2012 and 2013. That's why the IRS can't release its tax forms yet. That's why you can't get a 2012 1040, because they don't know what's going to happen with the AMT even for this year, let alone next. So we looked at, when we were doing this analysis, we compared to basically 2011, which is sort of the most recent year, which we kind of know exactly what the taxes are going to be. We don't know what it's going to be for 2012 yet, even though we're already mostly done with 2012. And we compared 2011 to 2013 full fiscal cliff. And so the potential lack of an AMT patch is actually a fairly important part of this for a lot of people, because if Congress doesn't pass one, then the AMT parameters get rolled back 12 years all the way back to 2000. So that is a large component of this for a lot of people. The people that tend to be most affected by this, again, are upper middle class families that have a certain number of sort of particular deductions. And actually, for North Dakota, when we were building sort of a profile of a typical sort of median family in each state, we used sort of IRS data. They have a lot of data on state-by-state deductions and so forth, to get an estimate of what a family making the median income in each state would have in terms of tax deductions. So, for example, the median North Dakota family actually would take the standard deduction and wouldn't itemize. North Dakota is a state that has relatively low state income tax, state and local income taxes, relatively low state property tax, and also my sense, although I have to look at this to be sure, is that home prices in North Dakota are probably lower than the national average, and so there's probably not huge mortgage interest being paid in North Dakota, versus other states. So, the sort of three biggest tax deductions that people take when they itemize are the thing I just mentioned. They're state and local income tax, mortgage interest deduction, real estate tax, and so forth. And for North Dakota, all of those are pretty low, so North Dakotans aren't deducting a whole lot. Two of those things, the state and local taxes and the real estate tax, those are deductible under the regular tax, but not under the AMT. So you would think that North Dakotans wouldn't be affected by this potential lack of an AMT patch, but you'd be wrong, because one of the changes that happens every year with the AMT patch is that the child tax credit is refundable against the AMT. When the child tax credit was first enacted about 15 years ago, and this is $500 per child off your taxes, and then the Bush tax cuts increased that to $1,000 per child in 2001. Part of the AMT patch every year says that, okay, you can take that credit against the alternative minimum tax. But that is one of those components that has to be extended every year. So if there's no AMT patch, that goes away. So not only are you getting hit by this huge increase in sort of what the minimum tax is going to be, but then you lose a huge portion of your child tax credit as well, because you can no longer take that credit against the AMT. So this is actually a big part of the puzzle for North Dakota. We're looking at the median household income for a 4-person family. Okay, so that's 2 kids. Okay, so if the child tax credit expires, or the increase in that from Bush tax cuts expires, that's $500 per child right there, because the Bush tax cuts doubled it. So you're losing $500 of the credit per child right there from just the Bush tax cuts expiring. And then, in addition to that, because there's no AMT patch, the alternative minimum tax goes up, and so you lose an additional $423 of the child tax credit, just because that is what it takes to get you up to sort of the minimum AMT that you need to pay. So that's a big component of it. So I mean, just to break it down, the total tax increase for North Dakotan families or the median for North Dakota family is $4,825. $1,000 of that is from the child tax credit ending as part of the Bush tax cuts. $1,704 of that is from the rest of the Bush tax cuts expiring. There's $423 of that, which is from this AMT issue and the fact that you can't take the child credit against it. And then finally, there's $1,698 from the payroll tax cut expiring. So all that adds up to $4,825, which is about 5.7% of the median household income in North Dakota, and that puts North Dakota ranking number 6 out of all the 50 states. So there's a lot going on. There's sort of no one piece of it which can be said to be kind of the biggest part of it. But all these things coming together are going to have a huge impact.
What about some of the different plans out there? It seems as though Democrats, for instance, are saying that they would like to keep in place for instance, speaking about the Bush tax cuts specifically, would like to keep in place those tax cuts for lower income, but raise them on higher income people. Do you have a breakdown of how, if that plan were to be implemented, how it would impact North Dakota?
Well, certainly, if you're looking at the median family in North Dakota, if you assume that the Democrats are honest about what their plan is and would keep those Bush tax cuts in place for everyone making under $250,000, then the median family would not be affected because the median household income is well under that $250,000 threshold. That being said, if you get away from just looking at what the median household pays and kind of look at an average across the state, we did do an analysis a couple months ago looking at kind of the sort of the average if you distribute kind of the tax increase across everybody in the state, kind of what that looks like. And I can tell you, if you give me a second, the percentage of families in North Dakota that are making over $250,000, because that's sort of an important component of this. Although it's also worth pointing out that there's a difference between kind of who pays the tax on paper and who's actually impacted by a tax increase. So raising taxes on people making over a certain threshold, $250,000, that is still going to have an impact on people who don't make that much, simply because there are all these kind of residual economic effects that result from tax increases. A lot of small businesses file under the individual code, and so that makes it harder to hire new workers if your taxes go up. And so that's something that small business owners are thinking about. Let's see. So it looks like it's pretty small as a percentage in North Dakota, people making over $200,000. If you look at the latest kind of IRS state-by-state data, let's go ahead. I assume you can edit this all later.
Yeah.
Give me a second here. Alrighty.
Well, even as you're looking for that, I mean, how many of these households that make under 250,000, over 250,000, a lot of them are assuming are going to be like business owners reporting their income as their business income as personal income. There's a chance that a lot of them could be swept up in this as well.
Right. That's what I was saying earlier. One of the sort of big changes, just not sort of so much recently, but just kind of in the past 50 years or so, and one thing that you have to kind of account for when you're talking about tax inequality and looking at sort of tax shares, historically, is that there's been a general trend towards businesses filing not under the corporate code but under the individual code. So, tax increases on the individual income tax side definitely affect businesses, not only because small businesses are filing through the individual code. I think it's something like about half of small businesses file through the individual code rather than through the corporate income tax, and certainly those are going to be in the upper brackets as well. So it certainly is increasing the cost of doing business. Those tax increases at the high end. So it looks like about 3% of tax returns in North Dakota, at least in 2010, which is the latest data available, reported income over $200,000. So that's sort of the number of returns that could be affected. But again, there are so many residual effects. If some of those returns are small businesses, okay, then all the employees of that small business are going to be affected. So the number of people that are going to be affected is going to be much higher than 3%, for sure.
Sure, definitely. Well, Nick, thank you so much for bringing some clarity to this issue and talking about how this impact is. It's certainly a confusing thing, and you appreciate groups like the Tax Foundation out there trying to do the math and help us understand what some of the potential outcomes for this are.
Sure, and if you'll just let me do a brief plug, part of the way we did this analysis is is we have this detailed tax calculator that can you can enter all sorts of detailed information into it. You know, you can enter your income, your capital gains, your deductions, number of children, filing status, so forth, and enter all that information in, and it will give you a personalized estimate of what your taxes are going to be under all the possible scenarios. So by default, you know, you look at full expiration of all Bush tax cuts, full extension of all Bush tax cuts, the second scenario, and the third possibility is what we just talked about, the Obama plan to extend most of them, but not all of them. So you can enter in all the information and get, you know, 3 columns that show you exactly how your taxes will be calculated under each scenario. And this calculator is sort of the public version of the same tool that we use to do this analysis for the median family in all 50 states. We basically just ran the median family through this calculator, but anybody can use it if they want to. They want sort of a more personalized estimate. So all you got to do is go to www.mytaxburden.com, and you can pull up the calculator and get your own detailed estimate of how you can be affected by all this.
That's mytaxburden.com if people want to go on and see an individual picture detailed specifically to them of how some of these scenarios might impact them. Nick, thanks again for your time.
Sure. Thanks for having me.